What's up, guys? My name's On the Desk. This is a Ventura County Real Estate Show. On the 17th of February, I sent out a newsletter. I'll have a description. I'll have a link in the description to the newsletter and the newsletter that I'm referring to itself. On the 17th, I sent it out. It's called Four Simple Graphs Showing Why This Is Not a Housing Bubble. I hear that a lot from a lot of different people, right? Everyone's still not recovered from 2008, we'll call it that, right? So we were all affected in some way. Everyone's having flashbacks to, the scramble for housing at that time. But, these four graphs hopefully will explain why myself and, experts in the business are saying that no, this is not the same thing as what happened in 2008. So let's get started. Graph number one here is so houses are not unaffordable like they were during the housing market, right? So there's a formula that people use to calculate affordability. But first off, year over year, home price appreciation is still in the double digits. I think that's a very important point to talk about first. Everyone's still gaining value in their home, right? Home prices are high. It's difficult to find a home to buy because inventory is low. But people are still appreciating equity in their home. And that's it's very different than it was, looking at this as wow, 15 years ago. But affordability, right? So when you go apply for a loan, there's a certain percentage that loan should take up of your income, right? And so purchasers should not spend more than 28% of their gross income on their mortgage, right? And if we look at this graph here, from Black Knight, they're a data service. You can see that, the standard is 28%. So they say, they look at that's why you have to submit all this paperwork when you are applying for a loan, right? They look to see if the, cost of the monthly payment of the home is no more than 28%, right? In 2007, right, people were, spending 34% of their monthly income on their home, right? At that time, they were, and we'll see another graph here a little lower. People were spending a lot more as a percentage of their total income, and people were applying for loans that shouldn't have. Right today, we're below we'll call the standard. Right, we're at 25.8% currently as the percentage of income that's devoted to paying towards your home. The average wage earner can still afford the typical home across the U.S., but the financial comfort zone continues shrinking as home prices keep soaring and mortgage rates tick upward. So that's important to understand, but we can see we still have a little bit of wiggle room from 25.8 to 28%. So that's point number one, how this is different than it was in 2007. Second, mortgage standards were much more relaxed during the boom, right? We can take a look at this graph and it pretty much jumps out at you right away. In the lead up and during the peak of the housing crash before that happened, people below 620 credit score, there were lots of loans, loan volume in the billions, and you can see the red bars from 2003 to 2007, how they were just giving home loans to anybody. We've all heard stories of, people having the lender fill in erroneous or, we'll use that word so that we can be fair and, not accusatory income information to have them qualify. I know when we bought the house that we're currently in 2012, it was a different experience than it was in, I think we bought our condo in 2003. They asked for, a lot more paperwork, verification of income, right? They wanted to make sure we had enough money in the bank, verified lots of things 2 or 3 times. And we can see post 2008, the number of people that are getting loans with below a 620 credit score is much lower than the lead up to the housing crash. So that means that the people that are in their homes now and going forward are being vetted a lot more, and they can really afford the home that they are in currently. Third, foreclosure situation is like nothing like it was during the crash. Yes, the caveat here is that there is a forbearance but I have another graph that I'll have in a different video that shows the number of people that went into forbearance compared to the amount of people coming out, be it paying what they had in arrears or working something out with their mortgage lender. They are coming out with ahead or not losing their home. So they have forbearance, but they're not going into foreclosure. People that did not have a loss mitigation strategy are still coming out with equity in their home, which is totally different than how it was in 2008 and post crash. So we can see that we are well below the number of foreclosures from 2018, 2021 compared to 07 to 10. We are well below the number of foreclosures than we had back then. Lastly, we don't have a surplus of homes on the market. We have a shortage. So we truly have, supply and demand is what is driving the market currently. We could see that the month supply of homes. So the standard for housing inventory for everything to be like at equilibrium is 6 months, right? So if we have 6 months of homes on the market, everything should be equal, right? It's, saying a buyer seller market with that many homes on the market is very difficult. So we can see in 2007 to 10, we had well above the 6 month supply of homes on the market, and yet people were still paying lots of money for their home because of what the situation was during that time. We can see now that we have well below the 6 month standard of homes on the market. Currently, we're at 1.8. I think I saw another updated graph at 1.6 months of inventory on the market. And this is what's really driving the home prices to soar. I think with these 4 graphs, we can see that we are not in the same situation we were in back in the market crash. You can, there'll be a link in the description to this newsletter that's you can sign up for. You can get updated, 2 times a week. I send out a newsletter. You can see that we're in a totally different boat, being the percentage of affordability that a home is as compared to your income, the lending standards that we see here, people below a 620 credit score qualifying. People now are having to go through a lot more vetting to get their home loans. The number of foreclosures we see here is much lower than it was during the crash. And even with the caveat of forbearance, we know that people coming out of forbearance are coming out in good standing or modifying their home, which was very difficult back in 2007, 2010. I know from personal experience. Now that is not the case. And we see that the true driver of housing prices is supply and demand, because we are well below our 6 month benchmark for home inventory, and compared to what it was during the crash, we are well below that as well. Inventory is totally what's driving this housing market. It's projected over the next 4 to 5 years. People are also worried of buying now what they consider to be the peak, and will they lose money on their homes? Be upside down as many people were in, during the crash. It's forecasted that over the next 5 years, people will continue to, and that's just how far out they forecast. People will continue to increase equity in their home, so they don't see a big dip coming as it did in the crash. So this data is very good to go over. The full article has more detail. Again, go to the website and sign up for the newsletter, and you'll get all this information. So Be patient. Homes are out there. You may have to look a little longer than you would like, but it doesn't seem like we're going to be in the same situation we're in back in the '08 housing crash. So my name is Andres. This is the Ventura County Real Estate Show. Please like and subscribe and share. Sign up for my newsletter. And you'll get information like this delivered to your inbox. Thanks a lot, and I'll talk to you guys next time.